Excellent. So my name is AJ Stoll with Econ Benefits, here to present the annual valuation report for the pension plan. So we've got two agenda items. The first will be the valuation report, and then the second is a potential plan amendment to help make the administration of retirements a little bit easier. So we'll start with the pension valuation on page 3. We're going to cover the highlights and then go into a little bit more detail as we go through the report. But on page 3, the main positive news here is that the plan had an 11.82% return for the plan year for the plan year ending December 31st, 2023. And so that is in excess of the expected actuarial rate of return of 7%. And that's going to go a ways in improving the funded position of the plan on a prospective basis. Contributions.
No, Tom, do you want an extra copy? If you guys want. Okay. All right.
Yeah, we got a couple right there too.
No, you're good.
Contributions for the year was 610,000, and that did exceed the value of benefits earned. So again, that's going to go towards improving the position of the plan. I think something that's going to be a bit confusing throughout the valuation report is we're going to talk about the funded status 3 different ways. So this plan is going to be measured 3 different ways and have 3 different funded statuses, but they're all the same plan. One of those reasons is because the discount rate that is required to be used for GASB reporting purposes is limited because of a projection that we do that indicates by 2055 on the GASB specific projection, the balance of the fund is expected to go negative. And so because of that, we are not able to use the full expected return on asset assumption of 7% to value liabilities. We have to use a lower rate, which increases liabilities, forces the plan to kind of increase their minimum funding on an annual basis to get the plan better funded on that projected basis. So we saw that there was an increase in this interest rate that we are required to use from 5.93% to 6.06%. So there's a bit of a liability gain on this basis. But one of the big funded status measures that we're going to look at is valuing at a 6.06% interest rate, which we're forced to based on the rules, and then maybe taking a step back and using 7%, which is our economic view of the plan and what we expect the assets to return. So overall, the plan on a present value of accrued benefits basis improved its funded position from 77% to 79%. And the unfunded position of the liability improved from a 10.6 million unfunded liability to a 10.17 million unfunded liability. So all that is positive, and now we'll kind of go through each of the pages and provide that in a little more detail. On page 4, this is the development of assets from January 1st, 2023 to December 31st, 2023. The plan had 21.598 million in assets as of the beginning of the year. Contributions of the tax revenue plus employee contributions totaled 610,000. We had a small accrual for employee contributions that were made in 2024 for calendar year 2023. So that's what that accrual is, very small amount. And then the earnings, that 11% return of 2.4 million, really buoying up those asset values. Benefit payments of 2.6 million, with an ending balance as of 12/31/2023 of 21.981 million. So an overall 400,000 net increase in the value of assets. As we move to page 5, this is reviewing the actuarial recommended contribution calculation. And we're showing 2023 on the right versus 2024 to provide 1 year of history. In the back of the report, there's a 10-year breakdown, provides a little bit more detail on this. If we zone in there, we provide kind of 3 recommended contribution alternatives. Your contribution recommendation is based on 2 components, a normal cost and an amortization component. The normal cost represents 1 additional year of service and 1 additional year of compensation being earned by all of your participants. So that is the value of the benefits that the participants are earning. The amortization component is an amortization of the unfunded liability that you have. And so the unfunded liability, we have three different amortizations, a 30-year, a 20-year, and a 10-year. You can think of that kind of like a mortgage. 20-year is your recommended contribution. But if you sensitize that, you can see if you wanted to pay it off faster or a little bit slower, what would that difference be? So overall, if you look at that 20-year payment, the normal cost was $504,000 compared to prior year of $520,000, so slightly lower. The amortization component, $897 compared to $940 for the prior year, again, slightly lower. The net is a $1.5 million when you adjust for interest by at end of year, and $1.2 million when you net out employee contributions. So that $1.2 million is the recommended tax revenue contribution that this mathematics would indicate the plan should be putting in to fund the plan to 100% over a 20-year amortization period. And then if you sensitize that to a 30-year, you'd be at 1.1 million. And if you wanted to pay it off faster, 10 years, that would increase the contribution to be 1.758.
Up on top in line 1 where it says estimated tax revenue contribution, what's the reason for the increase of 675 to 1 million? And maybe that's for Darren.
Yeah, that is made up of two components, and we confirmed that at the beginning of the year with Darren, a $650,000 tax revenue component, and I think we have a $350,000 additional contribution component earmarked for the 2024 plan year.
Darren, I forgot to.
We're missing a mic. I didn't hear, can't hear that.
It's more of a joke. And usually the last week of December, in order to make this work really good, we contribute, we forward all of the money we've collected to the trust. This year it happened in January 3rd. So it's
Just the timing.
Yes,
Got it.
it's my mistake,
Which means
but that is,
that's why the $1 million.
yes,
there
so
instead
it's
of
a boost in the
675.
next year. Yeah, there's no
Gotcha.
timing going on, it's just
Okay.
a couple days, but
That's why.
Mhm.
Okay, now I got it.
Yep, and that kind of ties back to the prior page where we see the employer contribution of 375,000 for
Right.
last year. So a little bit lower
I understand.
historically than. So then moving on from page 5 to page 6, unless you have any additional questions on the contribution. Okay, on page 6, this is going to be our first view of the funded status of the plan. Here we're looking at a present value of accrued benefits. And what that means is we are ignoring the future. We are only looking at benefits that participants have earned to date. So years of service and compensation through 1/1/2024. And on this basis, the bottom line is that the funded position is 79% on a present value of accrued benefits basis compared to 77% from last year. The top section is just vested versus total benefits at the bottom. So we're just zeroing in at the bottom. Then the next funded measure that we look at in 2 pages is going to do what I call more actuarial gymnastics, where we project benefits forward with projected salary. And we bring it back and try and smooth out the accruals that participants are earning. The way that pension plans work is the benefits are backloaded. You earn the largest value of your benefits in the last several years of your career. And so we want to fund that more ratably than waiting until the last few years of a participant's career. So the GASB rules use a different funding method that pulls some of the costs of those future benefits forward. And on that basis, you'll see that the funded status is 68.36%. Okay. These are also using the reduced interest rate assumption. So these are based on a 6.06% discounting of benefits instead of using a 7%, which is what we would normally use if we weren't limited by the calculations. So the third funded status measure that I would reference is 75%, which is using that 7% number and that actuarial gymnastic methodology. And we'll kind of walk through. That's what I would consider the plan to be funded as of 1/1/2024, 75% on that projected
So if we had
method.
$28 million in the plan, we'd be fully funded. Is that what you're saying?
You would be fully funded on a present value of accrued benefits basis. So ignoring all of the future
Right.
salary growth, you would be 100% funded.
So
Correct.
if we had $28 million, we could say we're done. I'm not
Not
saying we're done.
exactly.
I'm not saying we're done. Don't.
It would be
Sure.
close. So there would be some differences in what we would call a termination liability.
Mhm.
So this does still project out that cash flows happen in the future and they're
Mhm.
discounted back. A termination liability would change the assumptions and make all of the payments happen immediately. So it would be a slightly different calculation. There'd be gains and losses depending on how close people are to retirement. But it would be very similar.
Okay.
When you do those calculations, do you assume that the employee is gonna withdraw their contribution when they either retire or leave our employment?
When we are doing the valuation, we assume a life annuity. So the optional form that you're referencing, which is that the participant can take their employee contributions out and receive a reduced life benefit going forward, is actuarially equivalent. And so there wouldn't be a valuation impact on valuing that. Which is why we don't have a valuation impact. It's all valued as a life income for the participant.
Or if an employee passed away before, what happened to his or her contribution?
Yes, so if a participant passes away, they'd be eligible for the death benefit if they have not commenced their benefit yet. So if an active participant passes away, they would receive 100% of the benefit that they would have been due. They get the 100% joint survivor option, as if the participant made it to retirement, retired, selecting that 100% joint survivor, the spouse would get that 100% value.
What about the children? If the spouse is not alive, then it goes to the children?
It's a good question. I believe that it would continue. I'd have to go back into the plan document to confirm what the next level is past the beneficiary. There is the spouse is that 100% joint survivor. I believe that would continue to a beneficiary, with the caveat that there's a little bit of, you can't receive 100% joint survivor benefit if your age gap is too wide. You're trying to pay the retiree and not the children in the plan. Yeah, there's a hierarchy and a tier. I'd have to go back to the plan document. We don't see that happen too often, but there would be a death benefit that would be payable to the participant's beneficiary.
When you say death benefit, you're talking about death benefit or pension benefit?
It's a pension benefit, but it would be payable as a death benefit. So it's the death decrements and the death part of the plan document would take over, and not the retirement benefit section of the plan document. It's essentially the same thing.
But are they getting the time the death takes place? Are they getting the time when they would normally reach their normal retirement age?
Yeah, it's a good question. I'd have to go back to the plan document again to confirm the details there. Generally, there are options. Many spouses may choose to defer the benefit and use it as a retirement benefit for themselves and not allow an earlier payment. I'd have to check whether an earlier payment is available in this plan. All right, moving to slide 7. This is just an overview of the head count of the participants. So as of 1/1/2024, there were 53 active participants, 73 retired participants, and 31 deferred vested participants, those that are no longer working but still have a benefit due to them. Page 8 is a full reconciliation of liability as well as assets, with the funded status measure on the right column. We already went through the development of assets, so now just focusing on the far left column of that liability development. 1 through 5 are annual expected events. Every year we expect participants to earn a benefit. We expect the liabilities and assets to grow with interest. We expect contributions to come into the plan, and we expect benefit payments to be paid out of the plan. So we expected on an annual basis, going from line 1 to line 5, that the unfunded liability was going to increase from 10.6 million to 11.3 million. So that was all expected based on the level of contributions of 610,000 here. From 5 down to 7, these are the unexpected items, things that come up on an annual basis that we weren't expecting. Part of that is a change in actuarial assumptions. This is mostly the interest rate change, going from the 5.9 to the 6.06%. The higher an interest rate is, the lower your value of liabilities will be. So you saw a liability gain on the actuarial assumptions, and you saw a gain on assets of 991,000. That was the 11% return over our assumed 7%. So again, moving in the favorable direction, and then a loss on the liabilities from demographic changes. So from 1 year to the next, retirement's not happening as the assumptions would have assumed, deaths not occurring, things of that nature, saw a liability loss. So overall, the expected to actual saw a gain. And so the unfunded liability at the end of the day is 10.1 million compared to the 10.7 million at the beginning of the year. Any questions on that so far? All right, we're gonna go faster through the next couple pages. 10 and 11 provide a lot of historical context. So it goes back 10 years to say, okay, you know, what information can we gain from looking back at the history? And I think on page 10, you'll see an interesting story that the actuarially determined employer contributions from 2014 to 2022 were all at one level, and then they really spiked in 2023. And that's because in the bottom section, the investment return for 2022 was negative 13%, right? There was nowhere to hide the money. Bonds did poorly, equities did poorly. They have since rebounded quite nicely. But when you have a negative 13% investment return and you expected 7%, that's a 20% impact on the funded status of the plan. In 2023, there was an 11% return. You expected 7%, so you made up 4.8% of that initial 20%. So you made up like, you know, a quarter of how bad 2022 was for the plan. And so that really is what really spiked the plan. And this is what we're seeing across all pension plans. You're not on an island. This is how all pension plans are now rebounding from that economic activity. Page 11 really just provides that full reconciliation of liabilities and assets going backwards to see, you know, again, nothing particular to point out there, but I just think that that's a good place if you wanted to level set where were we and how did we get to where we are, to provide a lot of detail. The last page that I will point us to is page 16. And this is really our forward-looking health of the plan. What does the plan look like on a go-forward basis? So we're looking at two, what we call stability metrics. The top is the funded status of the plan. So for this funded status, we're using that actuarial gymnastic liability, projecting liabilities forward, pulling some of that cost back. And the funded status of the plan here is 75% funded. As the assets make up some of that ground from 2022, this is the direction that the plan is going to get to when we can bump up that interest rate assumption from the 6% to the 7% naturally. The bottom section is, how will this look going forward? So we've got a contribution here, which we're basing on the expected actuarial contribution of 1.2 million. The benefits that participants are earning, that normal cost component, is 392,000. And so you're contributing 837 in excess of the benefits being accrued. You're paying 7% really on the deficit because your liabilities and your assets are both going to grow at that 7% rate. And because you have a $7.2 million shortfall that currently exists, that shortfall will continue to grow with 7%. So that's the mortgage component of the pension plan. At the end of the day, assuming this contribution level, you will have a total excess contribution of 329,000, and the funded status will improve on this basis by 1.1%. So that's the trajectory that this level of contributions will have over the next year.
And that's over just 1 year,
That's just a 1-year improvement number.
because the expected contributions is obviously not going to be that.
Correct.
Oh, okay.
Correct, because it has that extra 350,000 in it from the carryover. If you took out that 300, if you use more of a $1 million number for contributions, you would have an improvement trajectory of 0.2%. So I think that's really where it stands. Generally pension plans were almost 100% funded about 2 years ago. And then 22 happened and now we're back in the position of funding the plans back up to make up for that economic activity.
Way to go, Tom.
The second item that I brought today is a review of a potential plan amendment. An issue that the current plan has with retirements is that the optional payment forms, one in particular, the one that we mentioned earlier, that allows a participant to take a part of their employee contributions as a lump sum distribution and take a reduced form of benefit. That calculation is done using a 2-month look back of interest rates. So if we wanted someone to retire on August 1st, we would look back to June interest rates to base that calculation on. And the IRS doesn't issue those June interest rates formally until roughly the 3rd week of July. So somebody that wants to retire on August 1st, we couldn't get them their forms before the 3rd week of July. And it compresses the ability for us to get participants the forms with their options with time to consider before they need to retire. So that's the situation. I put the language here from the plan document that outlines it. And then I put an optional form calculation for a sample participant. My recommendation, and something that would make the participants' lives a little bit easier, is to amend the plan to allow a 4-month look back. So you would basically go an additional 2 months back, and that would provide an additional 2 months to get the forms put together and in front of participants. You can also include a stability period of up to 1 year, and that would keep the interest rates used for this basis stable using, say, the September rates for the full calendar year. So every calendar year you would use the September prior. And that just makes the administration easier. From a participant's perspective, are participants better off or worse off if you do this? The answer is it depends. If interest rates go up or down in the meantime, that will dictate whether they would have gotten a slightly larger reduced benefit or a slightly smaller reduced benefit. We expect that to be neutral, but there's definitely going to be winners and losers in that situation.
So you're asking for a change.
I think it would be an improvement to the plan.
Okay.
Yes.
Is there a change we can make where nobody can get their money out and then we can? I'm just kidding.
You can make lots of changes.
All right, so what do most people do 4 months or do they do the year? What's pretty much standard?
I would say standard is 4-month look back, 4-month look back.
Okay.
Whether or not you do a stability period is not standard. I would say there's probably an even amount that use 4-month look back with no stability period versus those that just say, let's have an annual stability period. Both of them allow the same basic level of administration ease. There's more gaming of the system when you have a longer, I guess, time period between interest rates. Overall, this only impacts that one form of
Yeah.
payment.
I would just say do a 4-month
That was
look back and just make it simple.
that's why I was leaning.
Does anybody? Greg or Kent, do you guys have a opinion?
No, 4 months makes sense to me.
I do not.
Okay. All
So
right.
this is a recommendation to the council.
Yeah. Yes.
And is there a notification requirement to plan participants?
There would be a notification requirement, and it would also require that you would grandfather the 2-month look back for a 12-month period. And then it would wear away over that 12-month period.
Do we have to put this all in a motion?
You should put the change in a motion.
I mean, the verbiage that we're gonna vote on now, do we have to have, because we,
I don't,
I think an amendment can be ratified after a motion.
right, so I know what you're asking.
yeah.
Let me ask him a question
Sure,
first.
go ahead, please.
Okay.
I'm gonna sit
So
back.
are the rules about the grandfathering already in the plan?
No. The language just states you have to use a 2-month look back.
Okay, and so when we make the change, assuming the pension board recommends the change at 4 months and the council recommends the change at 4 months. You just said we have to grandfather the 2-month for a year, for a year.
Correct.
Is that requirement in the plan document? Or is
Yeah, that
that,
would need to be a part of the amendment to change from 2 months to 4 months, and then there would be language that grandfathers the 2 months for an additional time period of 12 months after the amendment is passed.
okay, so to answer your question,
Mhm.
yes, you have to put the grandfathering portion into your motion.
Right, but my question, I guess, is
The whole thing.
the verbiage that I'm gonna, or somebody's gonna espouse with this. I don't know if it's gonna be the exact, or maybe you should say the motion and then we can. Is that fair?
Are you talking about the legal language that goes into the
Yes.
plan document?
Yeah,
If you tell us what you want to do, we will figure out the legal language.
perfect. That was my concern. That was my concern. All right, so the motion is to change the plan instead of having a 2-month look back to have a 4-month look back. And as well as have a 12-month grandfather of the 2-month look back from the time we approve the motion, or the council approves the motion if they do.
Very well done.
Is
That
that
was
good?
excellent.
All right,
Second.
all right. Mike second. Is there discussion? Anybody? All right, all in favor?
Aye.
Anybody opposed? Any abstentions? All right. Perfect.
Excellent. Well, that's looking to close. I think the pension plan's in a good position to continue. But we'd like some more return from town.
Yes, I agree. All right. Thank you for coming. We appreciate it.
Thank you very
You can stay and listen to Tom if you want, or you can,
I'm glad you threw in actuarial gymnastics. I was hoping you would do that.
Especially during the Olympics.
Yeah, it's important.
Okay. Our floor, Mr.
your floor. You guys are up.
Great.
Please.
So we have second quarter. And then just a little bit of an update on things from a market value standpoint, some liquidity notes. And that's about it. Not too much for us today. If you jump ahead, skip all the information, you go to exhibit 1. Page 1. Up there. There we go. Beautiful. So page 1, as always, list your managers. Everybody's in compliance. No issues with any of the managers in the lineup.
Good.
Page 3 is your take-home page, just with kind of high level numbers on there, but we will go under the hood for some additional information. Pages 4 and 5, looking at the market value. So top of the page, you see ending market value column. Ending market value of 22,864,435. And you can see, as always, the various composites and the various groupings of investments within. And if you scroll down, you can get to the next page as well. You see real estate, private equity, and cash down there. Next page, just for kind of more perspective, page 6. We don't always touch on this, but figure I just would here. So just to get a feel for how this fund is allocated against other public defined benefit plans. Each one of these universes are, over the exception of private equity, about 200 different plans are in here, so it's not just Marquette clients. So looking at this, your US equity exposure is about 38% or so. That's about the 69th percentile compared to other public defined benefit plans out there. The median is about 45%. So equity markets run real hot. You're kind of obviously chasing it a little bit here by not having as much in US equities. You can go across the page there and kind of get a feel for some of the other asset classes. Private equity, you see, we're about 6.6%. We initially allocated 5%, but it's obviously kept growing through time. The median for the plans that do have private equity is about 7.3%. So, we talked about possibly adding more to private equity through time. And certainly for the plans that do have private equity, that is a very reasonable thing to consider. Real estate, right next to it, the median allocation is about 7.3% for plans out there. You're about 10.1. One of the things we talked about is eventually knocking that down. Also very reasonable to do compared to other plans out there. Page 8. Looking at the market value history, beginning the net cash flows. Obviously, we heard from AJ on obviously, cash flows within the plan. And then the net investment change during these various time periods on there. So for the quarter, I see obviously net cash flow was negative, about 135,000. Investments were up about 198,000 for the quarter. And you can obviously go back in time there and relive all the greatest hits of cash flow and net investment changes. Let's jump ahead to maybe pages 12. This gives us a little more perspective on how things are going. So this is at the end of June. Obviously not included in here is July, and July definitely saw a resurgence of small cap and value. So we are excited to see kind of how that all plays out. So for the quarter, phone was up 0.9 versus 1.0 for your benchmark. 60th percentile, as I mentioned, having less in equities than some of the other peers out there, certainly will in these markets will lag you a little bit. So year to date through the end of June, up 5.1. I'm guessing July was at least 1%, maybe more than 2%, because fixed income was also up. So hopefully at the end of July, you're at your 7% at that point. So
to clarify real fast
Yes,
here, so like under fixed income composite,
yes,
1 year, we are better than 5% of the plans.
you're better than 95%.
We're better than 95%.
Yes,
That's what I thought. So
Yeah,
it's
I know
backwards.
sometimes it's backwards.
Right.
when you think
So
about it.
I mean, one of the things I question about is I like our allocation. I mean, I think we have too much in real estate. We all know that. And
Yep.
if we could have 5% with the other 5 in US equities, we'd be in better shape.
Yes.
But why are we so low on compared to other DB plans? And I'm not, as I said, I
Sure.
like our allocation. I think we're doing a nice job.
Yeah, I called it out
but-
per conversation.
Yeah.
So combination of things. So one was obviously with principal
Mhm.
and principal and the equity side of things, you had to go active in equities to use those things.
Right.
Active equities, you all know, talking to the choir here, has not gone so well. Paying high fees and not getting that. So we shifted some of the assets out to obviously Vanguard. So that's been one part of it, is you're kind of hamstrung by
But we don't have a lot of equities left. in
benefit index.
Principal, do we?
You have none left.
That's what I thought.
Yeah, you have none
Okay.
left there. So big picture, that's been one thing through the years has kind of hamstrung you, but
Mhm.
that was that. Two, through the years we presented, asset allocation studies and, we're currently in a period here. Just for purposes of this conversation, to go to the next page.
You're talking about page 13 or page?
Yeah, just page
14?
13, just for
Okay.
the purposes of,
Uh-huh.
and I'll go back to fixed income. So you get the US equities, the Russell 3000 index, in the past 10 years, 12.1% annualized return, long-term is, 8% on there. So certainly outperformed there. We've been happy to have that. But, through the years, when we've given you asset allocation studies and talked about, trying to hit the 7%, but not getting too greedy.
Mhm.
All the data that comes out of there, has shown, extending yourself another 10 or 15% in equities versus fixed income really didn't play out from a risk return standpoint. Obviously it did here in data because we've had a historically great run. But kind of compared to others out there that are kind of reaching, maybe they have 7.25, maybe they have 7.5 still. One of the plans with AJ on is now at 7.5. They actually went up. And they're assumed not a public plan,
7.5%.
assume rate of return.
Assume, okay.
So for them, we've got to push it further on the equities. So it's a combination of principal kind of constraining a little bit, and also, you guys have been thoughtful on kind of the risk return dynamics on a go forward basis with equities and fixed income.
But
Half of the real estate over allotment would probably be part fixed income, part equities. We didn't have that.
actually
Overweight.
probably be more all equities,
Well,
I would say. I'm just saying, because I mean, we've got our 30% fixed income.
Yeah.
So the real estate, if we push it down, we're not gonna go to 35% fixed income, I don't think. I wouldn't recommend it. But, yeah, I mean, that's hurt us a little bit.
Yeah, and fixed income, you know, right now you're 39.
Fixed income's been.
You're
that's
fifty,
not
yeah,
terrible.
you're 39th percentile. So you're got a higher allocation, obviously a little more than half of the plans out there. But not a huge outlier.
Right. No, I'm comfortable with the 70-30.
Yeah.
It just, and as I said, I like our allocation.
Mhm.
It just seems like we're just not performing.
Yeah, and it's
Yeah.
I did this exercise for a large endowment and we just mocked up one. They were all active and
Yeah.
it's tough, but that's what they believe in. So we try to find ways to do that. So they're all active. And then also, they were a little under on the equities. So we just said, okay, what if you went all passive and you added 5% to equities from where you currently were?
Mhm.
Boom. Just even 5% because it's gone up so much more than everything else.
Right.
Has made a huge difference in the past 10, 15 years.
Right.
Page 12, you're there, you're doing great. So looking at the actual individual fixed income managers, so for the quarter, 0.4 versus 0.1, doing well. You know, ranking wise, obviously year to date up 1.1 versus negative. Ag did flip positive with June's returns. So expect to see our lineup that you have here bounce up as well. So principal core, you see on there, obviously it's, you know, been in line with the benchmark year to date, negative 0.7 versus negative 0.7. Principal core plus, that is protected a little bit. Rankings aren't so hot there. You know, you think about even under the hood, you know, we've talked about in the past, if we were ever able to diversify more away from principal like we did with Aristotle, we would like to do that, but that's just not an option right now. Principal high yield, that, you know, has overall done well in recent times, year to date up 2.7, for the quarter up 1.1. And then Aristotle Pacific, as I mentioned, that's the one that hired basically almost 2 years now, 2 years ago in September. You see that has been very helpful. One of the bigger, that and high yield, obviously, been one of the bigger drivers of your success with your fixed income. So next page, US equities. So for the quarter and more so June was driven by the S&P 500 and driven by Magnificent Seven. You see mid cap was negative and you see small cap was negative during the month of June. July was a flip of that, pretty significant flip of that, but you do see kind of how things were driven by the S&P 500. So year-to-date numbers also being driven heavily by the S&P 500, the Vanguard mid cap, and then the iShares. Both of those were funded in April. Remember, you had mid cap value, mid cap growth, small cap value, small cap growth. We just kind of consolidated all that and reduced some of you had an inherent overweight on the mid cap and small cap. We just reduced that. Non-US, flipping over. For the quarter, good quarter, 1.7 versus 1.2, trailing year to date, 4.9 versus 6.0. For the three Vanguard funds, you have the total international stock index. You have the small cap, which outperformed large cap a little bit for the quarter, but behind year to date. And then EM, we saw EM was a shining spot during the month of June, which has kind of given them pretty strong numbers here. So we've seen EM finally overtake developed this year so far. We'll see if that actually continues. Principal for real estate, that was -1. Benchmark was -0.7. Year to date, -3 versus -3.2. So compared to some of the other private real estate funds out there, continue to play good defense. Overall, and like we're starting to see, obviously, some of these negative numbers shrink, and hopefully we have the income component still there, and you see some of the valuations kind of level off, and then we can kind of flip this positive. Jonathan will have an update at the end on the redemption process there, which is things are starting to open up, so that's good. And then private equity has been quiet this past year compared to historical returns. Don't have the index for the quarter, but that was a little bit negative from the numbers I just saw. So year to date up 1.1 versus 1.3, so it's just been, I said, a very quiet period historically for private equity. And then cash 5.6% for the 1 year. 1 year trailing. Obviously, once the Fed does cut, you will see that go down the quickest of anything. But obviously, if they do a quarter here, 0.5% here, still, the returns that we'll be getting, at least in the foreseeable future, will be, far beyond what we dealt with since the financial crisis. Next page just has kind of all historical returns. Next couple pages. And if we jump to page 21, touch on fees here. So as always, asset class manager fee schedule, estimated annual fee, and then just some more information on expense ratios and the industry median for those types of investments and those types of vehicles. So you're paying about 39 basis points for the plan, just a hair ahead of the industry median for those types of investments. Some of your principal investments, those are higher fees than the norm out there. And obviously, especially in fixed income, obviously the spread you would try to get on that versus the aggregate index, those really add up. So you think about kind of the underperformance that principals had, if you were getting 40 basis points less annually on something that you're trying to earn, 3 or 4% on, that adds up through time. So that certainly has not kind of helped your numbers here. You have our fee, and then you have the Regions fee, and all at the bottom there, you have the total fund expenses. Before we kind of get into asset allocation and liquidity updates, and all that, any questions on this part of the journey? Okay. So kick things off, you go to Exhibit 2. And first page will be just the market value page. You see kind of current updates, and then also the flipping that over is the benefit index that I sent. Yeah. I sent the update a little while ago. So to tee things up here, so as you're looking at the market value page, see some activity on there. As I mentioned, the goal is to, as you start getting more of the real estate money back, and I said Jonathan will have an update on that. Then we can talk about deploying that likely in next year. I would think, based on kind of how things are progressing here. So I will shut up for a second and let Jonathan take this.
Thanks, Tom. All right, so on the rebalance sheet there, we have all your values for all your investments as of their most recent statements as of the end of July. You see quite a decent amount of growth there on the bottom of the page. You're at 23.25 million roughly. And I was doing some quick math because Tom did mention how there was a resurgence in small caps and value over the course of July. Did quick math, about 1.65% return roughly for July, which is huge.
It gave back about 3% today.
Sorry.
And it gave back about 3% today.
Yeah, maybe. We'll have to see once we get all the statements actually. But anyways, as Tom mentioned, it looks like we are kind of seeing somewhat of a bottoming in real estate. You see in the middle of the page there where principal U.S. property is. I have a little note there. You have about $798,000 left in your redemption queue. That's after we upped it by about $500,000 in May. And I'll let you know what you got back on the 26th of July. They sent your payment out for the quarter. That was about $82,400. So they've been upping it as the quarters have gone by. So hopefully maybe next quarter we'll see 150, 200,000. Fingers crossed. But a lot of the managers in that space are fairly confident that they're seeing a bottoming in prices. So we'll see if that comes to fruition. Anyways, as you go closer to the top of the page, you see we have some suggested changes, and we're recommending, as usual, we take from where we're overweight and we place some funds back into the principal core fixed income account. That's where you pay benefits out of. So I'll just start from the top. We recommend taking $250,000 from the Vanguard S&P 500 fund, $35,000 from the Vanguard Mid Cap Fund, $110,000 from the iShares Core S&P Small Cap Fund, 28,000 from the Vanguard Total International Fund, 3,000 from Vanguard Emerging Markets, and 13,000 from Vanguard International Small Cap. And all that will go to the Principal Core Fixed Income Fund, along with $100,000 from your cash held at Regions right now. And that will total up to $539,000 inflow into the Principal Core Fixed Income Fund. We'll just need your approval to make that, to raise that cash and transfer it over.
We've been trending, I think, 400, 500,000 a meeting that we have to keep refilling kitty.
Why does the Fidelity cash get so high? Is that part of the prior principal payment?
Yeah, so that's where that principal money ended up,
So
as
the
well as,
82 is already reflected here?
yep.
Got it.
Unfortunately, it's going right back to principal, but you know.
Motion to
Uh,
somebody, or I can say a motion. Motion to approve the recommendation that Marquette is giving us regarding the changes in the proposal. Is there a second?
Second.
Now we can discuss it. Is there any?
Makes sense to me.
Alan, do you have any?
No, I mean,
Just me, anything?
Yeah.
All right. Then all in favor?
Aye.
Any opposed? All right. Perfect. So you can do
next
it.
page, it's just
Yeah.
just a cushion. Things are in good shape here. So as we think about eventually more funds leaving principal, perhaps going to either public equities or private equities or a combination thereof. You know, we feel like you're getting into a lot better place to be able to do that. 5% out, especially from real estates.
Yeah.
Reasonable.
Would we need a pullback in the market to leave principal? Like right now with the rebalancing, I'm just thinking,
Would you, sorry, see that again?
I just thinking about this first thought that I had was, do we need to have a pullback in the market to be able to leave principal to go to Vanguard? If the market continues hot, we're continuing to rebalance out of Vanguard, sending money to principal.
Yeah. Yeah, obviously, market keeps running, but obviously you keep behind the scenes, obviously that core fixed income is, paying benefits. So either way. So obviously when markets and equity markets sell off and you have to obviously keep continuing to pay that. That's not the best combination. Yeah.
All bad. All right. Thank you, guys.
Okay.
Yeah.
So it's important to do it now when the markets are up.
Yeah.
So that.
All right. Discussion. We did that. Oh, discussion review of plan benefits.
Thank you.
Did we do that? Is that what we just did?
You did that with AJ, and that was the look back.
Gotcha. Perfect. Okay. Excellent. All right. Is there anything else? Any new business, old business? Anything? All right. Then we will adjourn the meeting.
Thank you, everyone.
Thanks, Greg. Thanks, Kent. Oh, they can't hear me. Thanks, Greg. Thanks, Greg. Thanks, Kent.
Yeah, thank you.